Welcome to day 3 of our GPAG conference. The topics of yesterday's discussion further highlighted COVID-19 key challenges faced today. Our focus today is on transformation. We hope you were able to watch the recording on digital transformation underway at Wells Fargo. It provides some important insights from our key leaders. We have 2 discussions scheduled for today: digital trends in banking and technology as an enabler in a rapidly changing environment. We will conclude with a combined open dialogue and live Q&A for both topics. We welcome your questions and please direct them by email to globalpaymentsadvisorygroup@wellsfargo.com. Thank you for joining. I will now turn it over to Braden Moore, Head of Strategic Partnerships at Wells Fargo, to moderate our first session.
Hi, thank you for joining me today. My name is Braden Moore. I'm an Executive Vice President, Head of Strategic Partnerships at Wells Fargo. I'm very excited to have you with us today as we talk about digital trends in banking and the transformation of our industry. We've got some excellent guests today to discuss the issues. We'll be doing some content followed by discussion and a little bit of Q&A. First up, you're going to hear from Kaushik Rajapal. He is the co-managing partner for McKinsey in their US business. He is also the co-managing partner for their Fintech practice globally. Then we're going to hear from Stephen Gilderdale at Swift. He is their Chief Product Officer. He's also served as their Chief Operating Officer and the Chief of the platform. So some very interesting information from kind of a network perspective. And then we'll wrap it up from a view from an incumbent with Michael Schumacher. He comes to us from PagoFX by Santander, where he is the treasurer and head of payments. He's also active as a member of the Ripple Net Committee and has previously been involved in the development of commercial and institutional products at Santander. So before I turn it over to Kaushik, what I wanted to do is to quickly offer one viewpoint, which is technology is changing our business and challenging us to keep up. So yes, it is a threat, but it's an incredible opportunity for those of us that are able to think and act boldly, and for those of us that really are able to embrace transformation. So with that, I will turn it over to Kaushik to get some insights from him and his team at McKinsey. Kaushik?
Thank you, Braden. It's a pleasure to be here. On digital transformation, I want to leave you with 2 overarching thoughts. The first is that with a combination of low and zero interest rates, disruptions due to COVID, and technology, digital transformation in banking is now an imperative and not a choice. The second is that when done well, with attention not just to what you do in digital transformation, but how you do it, this is not a winner-take-all endgame, and a combination of tech ecosystems, fintechs, and banks that adapt will win. With COVID, banking is undergoing significant shifts. Everything from changes in consumer behavior and preferences, for example, on the usage of digital channels, which may be persistent, on branch usage, to the drop in revenues as a result of the recession and low zero interest rates. We also expect that there will be durable shifts in preferences, for example, on contactless payment methods because of COVID. And when we step back thinking about overall banking revenues around the world, segments such as retail and SMB banking and corporate banking will be relatively more disrupted, with some secular tailwinds around digitization. Payments and other areas will be less disrupted. But broadly, the industry faces an imperative for digital transformation. If we look at the landscape of attackers taking aim at banking in this context, we see a stunning amount of capital flows. In the last decade, more than $100 billion have flowed into fintechs of all kinds. And globally today, we see 68 fintech unicorns valued at over $280 billion. At some level, this is capital conducting experiments, because banking is a difficult industry to disrupt. And we've seen this movie before if we go back a few decades to the dot-com era. From the IPO of Netscape to the acquisition of PayPal by eBay, we saw about 480 different fintechs taking aim at banks. Less than 1% of them survive as standalone entities today. Today, we see more than 4,000 fintechs taking aim at banks. The disruption potential is real, as you see here, but a combination of regulation and the position that banks hold as stores of value and regulated, trusted suppliers of credit is a challenging mode to overcome, and banks have many advantages if they digitally transform. Many fintech attackers do not want to be heavily regulated entities and are focusing on customer relationships relative to being regulated balance sheets. On this slide, you see the potential revenues in play on the left-hand side from the balance sheet and on the right-hand side from origination and sales. It's worth noting that the return on equity for staking out a position on origination and sales is nearly 20%, about 5 times that of being a regulated balance sheet. And so while fintechs focus on this, they also struggle to manage down the cost of customer acquisition, where banks have had a historical and durable advantage. When we think about banking transformation, incumbent banks are transforming digitally, and we see numerous examples of successful transformations around the world. This slide highlights 7 key ingredients for how you transform digitally. It's not just about technology delivery and transforming that. It's also about putting it in the context of a holistic vision, having a specific list of priority initiatives to pursue, ensuring that the delivery is actually scalable, partnering where it's appropriate, and also having a sense of quick wins to create and maintain momentum. In a COVID context, it also means adapting to that environment. What does an agile war room look like, for example, if you're working remotely? How do you make that practical and sustainable? Across the world, we see several examples of compelling digital bank transformation journeys, and you see some examples on this page. This could include a holistic transformation, as you see with the European Bank on the left, which is a multi-year transformation across channels, products, and tools, with agile labs and ways of working at the center of the transformation. The example of the Eastern European Bank is a much more rapid transformation with a set of agile teams, but also a focus on new digital offerings and digital channels to counter fintechs. So there isn't a single recipe that is always the right answer, and banks can adapt digital transformation approaches and playbooks to their unique contexts and cultures. Digital bank transformations are also not just about technology. When done well, we see them offering stacked wins across revenue, productivity, and customer satisfaction. A digital transformation that does not offer benefits across all these elements is a transformation that is probably underachieving relative to the potential. As a couple of examples, digital credit in the corporate and SME space is an area where we are in the early innings, and we see significant potential with time to decisioning, reduction in operating costs and productivity, revenue uplift from innovative new products that use data differently, and reductions in credit losses through the cycle, if done well. More holistically, there are several banks, DBS is an example, that are pursuing full stack digital transformations, that are reinventing how the entire bank works, becoming digital to the core, moving from legacy manual waterfall approaches to more agile approaches, starting with a zero baselining for operations, and creating an ecosystem of services for customer journeys across segments. Also, beyond banks, fintech platforms are pursuing ecosystem opportunities. And ecosystems include services in multiple arenas, ranging from healthcare to education, where banking as a layer can add significant value to customers. The ecosystem model is most pronounced in China. Unlike the West, where many fintechs are pursuing more traditional approaches, in China, the majority of fintech investments and successes have gone to affiliates of just 5 large tech ecosystems. This may not be a model that's replicable around the world for a variety of reasons, including regulation, but it is worth noting that the tech ecosystems are here to stay in banking. In conclusion, we would say that the digital transformation endgame in banking is not winner take all. In fact, it rarely is in a regulated industry because regulation is part of the moat. Winners will include adaptable financial institutions, as you see here on the top right. It will include tech platforms, which include large ecosystems that have a cost of customer acquisition and scale advantage, provided they navigate regulation well. Many of these players will partner for risk and regulation with banks. And then finally, on the left here, fintech entrants will struggle to succeed to build standalone businesses, but they will create pricing and margin pressure that banks will have to navigate. And they will come both as attackers and enablers. Many of these will not survive as standalone entities, but they will be positive catalysts for the digital transformation of banking. Thank you.
Great, thank you, Kaushik. That was super insightful and just some great content, some great thinking, which I've come to expect from you and your team. So thank you for your advice to ourselves. I know you have a large business working across many different companies, but obviously there's a lot here that people need to be thinking through for their own institutions and what it means for them. So thanks for your time. Next up, we're going to hear from Stephen over at Swift. And so, Steve, I'll turn the floor over to you.
Thanks, Braden. So I would like to share the story of Swift and hopefully bring to life some of the points that Kaushik touched on as we go along. I think it's fair to say that digital has always been at the heart of Swift. And in fact, our very existence is based upon the original drive from banks to digitize the fax-based transactions used for correspondent banking and by extension, cross-border payments in general. Of course, since the 80s and 90s, when digital economies accelerated, the definition of a digital bank has really evolved and extended, starting with online presence and eventually crossing front, middle, and back offices to change the heart of the bank, its business and operating model. Today, I think truly digital banks interact with customers through diverse digital channels. They manage and execute their business fully electronically, that's to say, really in the digital domain. And of course, by doing so, they improve customer service and experience, becoming more efficient and hopefully reacting faster to change as well. But I think they also go further. By using technology to drive new business models, such as APIs powering an interactive real-time ecosystem, or artificial intelligence enhancing customer service levels, or making service available anytime, anywhere. And Swift is no different. You would expect it to be no different as well. We've not stood still, and we have embraced technology over the years to provide innovative services to banks, their clients, drive cost savings, reduce risk, improve competitiveness, and all in an increasingly agile manner. And our new strategy is a perfect example of this. We're making all financial transactions, even those that involve the complexity of cross-border, frictionless and instant, just like the best domestic infrastructures. And we're enabling a better client experience through end-to-end management of those transactions and transparency of rich data back to the end customer. Of course, we're building in the security, reliability and compliance that we're renowned for. And we're enhancing the richness of data, really the oil in the engine, by implementing ISO 20022, which importantly is a data standard, not a messaging standard, and doing that everywhere in our systems. But to achieve all of this, we really need to change the technology, and we're building a new interactive and digital first platform, powered by APIs and orchestrating an interactive real-time process rather than relying on the serial messaging process of today. So we're ensuring the frictionless part of the transaction by bringing together data and compliance services, pre-instruction, getting all of that payment data complete and right first time, and therefore ensuring that the payment is safe and secure. We're then delivering instant by executing with all parties in the chain as fast as possible with transparency and certainty. But as Kaushik mentioned, and as I implied at the start, digital banking to me at least, is just as much about how you do things as what you do. Oftentimes, it's an overwhelming challenge to build a digital ecosystem, the business network from scratch. So we are offering backwards compatibility as we do this, allowing our users to move at their own pace, but still be reached by everyone on the network. Full transaction data, for example, stored in the Swift cloud, will enable us to mediate between the different protocols and formats and make full data available to those who need it, but might not be able to process it yet. We're using cloud technology, which allows flexibility in terms of both scale and feature. We're co-creating with customers using agile methods to drive a more effortless customer experience. And we're building an open platform to enable partners to plug in new capabilities. As we move forward, we're going to build on this as well to bring artificial intelligence, machine learning, to drive out exceptions and manual operations and improve effectiveness and efficiency of things like screening and fraud detection even further. So while Swift has been a digital platform partner for banks for many years, we are innovating faster than ever and making sure that banks can become truly digital in a seamless way, all the way from front to back office. Maybe to conclude, what would be my key takeaways? I would say, don't think that electronic is the same as being digital. Everyone focuses on what they provide as a service, but I think many do not focus on how. And it's really here that makes a difference. It's here that fintechs often excel. Proprietary closed APIs, as an example, are not the same as open standardized APIs. Traditional applications are not the same as cloud native applications. And if you want to differentiate both operationally and drive better customer value, in my view, how is just as important as the what. Thanks.
Great, thank you, Stephen. Really appreciate your comments, and just want to highlight the importance of the work you're doing for the industry. You're really the glue that keeps us together in cross-border payments, so appreciate the work you're doing and the aggressive innovation that's coming from Swift. It's really great to see, so thank you. So next up, we're going to turn it over to Michael. He's going to talk to us about PagoFX by Santander. So Michael, why don't you take it away?
Thanks, Brady. The first thing you need to know about Santander is that we're the largest bank in the Eurozone by market cap. The second thing you need to know about Santander is that we're not one bank, but 10 plus banks fighting over the same name. What started out in 1857 as a local bank in the port city of Santander, Spain, over the next 100 years grew pretty steadily, becoming one of the largest banks in Spain. Then, in 1950, it started its expansion into South America, where it could see both sides of the trade flows between Spain and the continent. In the 1990s, it decided organic growth was too slow and has spent much of the past 25 years on a huge acquisition spree. If you go through the history of each of those acquired banks, it comes out at over 100 different institutions that have become what is today the Santander Group. Each of those acquisitions came with its own platform, its own network, and the 2000s have largely been a story of successful integrations. Today, the banks in those 10 core markets are running on a few variants of 3 different platforms, supporting 146 million customers and holding $1.5 trillion in assets. Around 40 million of those customers are digital, preferring to interact with us online rather than disturbing the carpet in our branches. It is in that digital segment that we see the future of the bank, and to which we've committed 20 billion euros of investment. Today, I'm going to talk a little about how we are spending it. The biggest beneficiary of the spending is payments. And like the 2 panelists before me, I see enormous changes on the horizon. Pretty much every country and every bank the world over is upgrading its payments infrastructure, or to a large extent has done so already. The most radical will, I think, be synchronous or conditional payments. Rarely do people make transfers just for the fun of it. Rarely does a single leg exist in isolation. There is always an economic reason behind the transfer, whether it's trading physical goods, digital services, exchanging your hard-earned cash for shares in Pfizer, or a chain of people buying houses. The payment in each of these events is linked to something else that is today separate. Someone always has to make the first move, and in doing so, takes on an element of settlement risk. There has to be enough liquidity in the system for all of these payments to happen gross rather than settle net, and for those reasons, there are huge savings to be made in capital and reductions in risk by linking our payment systems with other infrastructures, either in the financial world or logistics, and making sure everyone dances perfectly in time to the music. But talk of capital and risk is boring. The most transformative in the short term will be instant payments, making cut-off times and value dates obsolete. If you need to move money internationally over the weekend, take it out in cash and hop on a flight. Well, to the extent we can under current circumstances. To bring the world's economies together, we need to start with 24/7 and quick, ideally instant payments. We should abandon the concept of value dates in favor of now. Somebody in Australia should be able to send money to the US, where it's still yesterday. To support this, we need to speak the same language. English is the language of commerce, and ISO 20022 will be the language of payments and much else. With few exceptions, we see new payment infrastructures are being based on this. Open banking continues this interoperability and extends it beyond bank-to-bank settlement to our customers, giving them unparalleled choice in how they interact with financial service providers and paving the way for products that we haven't even thought of yet. And sooner rather than later, we'll see the world's major central banks going beyond cash and reserves and issuing a new type of money, central bank digital currencies. Hopefully just to commercial banks and not to retail customers, where I think we could see the end of fractional reserve banking and a far larger transformation than any of us are comfortable with yet. Back to Santander specifically, we have quite a clear choice in the years ahead. Each of our core markets has one or more platforms, each with its own balance sheet, payments infrastructure, and customer-facing channels. So the choice is, do we make all of these changes many times over, or do we invent the wheel? And the path we have chosen is to follow a global model, a global payments hub and balance sheet spokes coming off it. All of the clever stuff, all of the payment scheme integrations will be centralized, leaving behind just the balance sheets in the individual countries, entries on the ledger that originated on this new global platform. What works well for payments works equally well elsewhere. Our intention is not to replace several monoliths with one new monolith. Rather, we have a number of central services that fit together like a jigsaw, and with each other and with the banks. Centralizing and replacing isn't that exciting, and certainly doesn't come cheap. With the rest of the 20 billion, we thought we'd try new things. Create from scratch with none of the legacy technology headaches, and with a less staid approach to governance, yet still following the bank's high compliance standards, an open financial services, digital first or only ecosystem. Great platforms for customers that are also consumers of the centralized services we've created. The left-right layout of this slide doesn't quite capture how these fit together, and I think I need to show it in a way that's a bit more snappy. The cost-income crocodile. Like comparing a widening cost-income ratio over the next few years with the jaws of a crocodile. My favorite of the new bets is PagoFX, and I'll talk to you a little more about that. PagoFX is Santander's attempt to bring the world a little closer. An international money transfer service open to anyone with a bank account or debit card, no need to be a Santander customer. With a slick onboarding experience and leveraging every new innovation in payments that's coming, we want to offer everybody quick, low-cost international payments, but with the security of the backing of a bank. And the customer journey here is king. In 8 clicks, we can take you from signing up to making payments. Much smoother than anything traditional banks have offered so far. Much more customer friendly. And I spent close to a decade working with Santander and its technology. And for reasons of legacy or too many layers or bureaucracy, progress has been hard. With PagoFX, with the new ventures, we found it to be much easier. Take the same expertise and starting with a blank canvas, we've been able to build a fantastic payments platform in record time. A platform that will not be copied and fragmented, but serve many geographies and legal entities from a single instance. A platform that is the product, like the tech companies that become to dominate the tech. A platform that is the product, that like the tech companies that become to dominate the stock markets, is more valuable than the sum of its parts and what has been spent on it. And with the end-to-end digitization, structured and democratized data allows us to meet the bank's compliance standards much more easily and without causing unnecessary misery for customers. A platform that seamlessly plugs into the other services that Santander has created. And finally, a platform we're very proud of and are happy to share with our banking peers. If anybody with a license wants to come to us, we'll happily share this with you, and you can bring payments innovation to your customers too.
Great. Thank you so much, Michael. That was really insightful. And I think Santander is really a leader in this industry relative to embracing digital and looking across all the different markets and all the different products to really bring some of the best of technology to their customers. So congratulations and amazing work with PagoFX. So great. So we just had three great presentations from my guests. And what I'd like to do with the few minutes that we have remaining is to just kind of open it up for some discussion. We've all been talking about the digital trends and how that is transforming our business. I mentioned in the beginning, the imperative. I think Kaushik came back to really bring that into relief and to provide some context about how that would happen. With Michael's presentation we just got through, you can see how Santander has already been thinking through these issues. And then if you think about what Stephen had mentioned, the leadership that the network plays and how this industry ties together and how important it is that the folks that are infrastructure are making big investments. But one of the questions I wanted to offer to the panelists and see who wants to jump in on this is I'm always of the opinion that catalysts are very important. There's a lot of inertia in this business, a lot of reasons why things don't change. And so I'm always keen to be on the lookout for catalysts that are coming towards us. So I just kind of offer that, what do you guys see that's coming at us that might accelerate the pace of change, create the opportunity for some leapfrogs?
That's a great question, Braden. Maybe I'll offer a few thoughts to start out. First, I think banking and in particular payments have significant inertia. Payments especially is a business with high net worth effects and scale benefits, and with that comes real inertia. I remember talking with a serial entrepreneur who had failed its multiple payment startups, and his observation was that if you build a business that is marginally better in payments, you will lose because of the inertia. You need to build something that's a step function better in terms of speed, scale, cost, transparency, or you need what I'd call a dictator effect, which means some change in regulation that causes things to operate differently. Near term, I see three big catalysts. One of them is regulation. Mike talked about big changes in payments, multiple central banks moving to real-time payment systems, open banking, which opens the door to third parties in banking. That's one big one. A second big catalyst is the imperative for productivity in banking. Last year, we found that nearly 2/3 of banks globally do not recover their cost of equity. And a zero, low, negative rate environment is a big culprit for that, for what has historically been a business with attractive margins. And that environment isn't going away quickly, as multiple central banks have signaled around the world. So the imperative to dramatically lower cost income ratios for banks around the world is here to stay. So that productivity imperative is a catalyst. And then finally, as I noted in my presentation, the behavioral changes from a customer perspective that COVID ushers in could be durable in many ways and could be an additional catalyst for digitization.
Great, thanks, Kaushik. Anybody else want to jump in on that one?
Yeah, maybe if I could just add to it, because I think there are inherent drivers for digitization which any company should be aware of and should be pursuing, and they can be internal or external. They can be competition, they can be customer requirements and productivity requirements, as Kaushik was describing. I think when it comes to catalyzing that though and accelerating it, yes, absolutely, regulation, extraordinary external events like COVID, they are definitely at the top. I think there's also the rate of digitization which is happening in other industries though, and that all of us as individuals experience, as consumers at home, and actually expect the same when you go to work. So whether it's in a B2B industry, whether it's in a B2C industry, you just expect this kind of smooth, good customer experience, everything to be available whenever you want it to be available. That when it's super busy, it's Black Friday, for example, you can get on your website and it's going to work and you can buy your TVs, whatever it may be. So I think there's this extrapolation of consumer life also into B2B as well, which has a link and drives and catalyzes the innovation that we're seeing also in financial services and in B2B as well as in B2C.
Great, thanks, Stephen. Michael, looks like you had something.
Yes, I think we're finally starting to see some free market competition for banking and payments. And it's not coming from the banks in every case. We're seeing the fintech competitors come along, and where banks have always had to make a profit, fintechs are putting customers first and thinking about the experience, even if it's loss-making. And it's drawing customers. For the first time ever, I think you're likely to be less sticky with your bank than get a divorce. We're seeing customers try out the likes of TransferWise, Revolut, where they're attracted to free, and banks need to defend against that. We need to innovate to keep pace.
Great, thanks, Michael. So I think that's a great kind of first question. We're going to open it up into some general, Q&A now. But what I would highlight is, I think, as an industry, it's not that the industry is going to topple in this transformation, but there's an opportunity for certain companies to differentiate, to lead, and to change. And I'm sure that there's going to be, one of these companies that has grown with a lot of capital to be a competitor, but we all work in a very competitive space. And so my sense is that, we'll have a digital competitor, but they'll be one of many, and that the spirit of cooperation and competition in this industry will continue. So, thanks for bringing in your content and presentations and doing the question and participating in the Q&A. Thanks so much.
Thank you to Braden and the panelists. Let me now introduce our next panel topic for today: technology as an enabler in a rapidly changing environment. Moderating this session is Siavash Alamuti, Head of Research and Development with Wells Fargo's Innovation Group.
Good day and welcome to our panel on technology as an enabler in a rapidly changing business environment. I'm Siavash Alamuti, Head of Innovation R&D at Wells Fargo. We have three distinguished guests today: Tom Schack, Chief Innovation Officer at Swift, and Marie Facciolini, Wells Fargo's Chief Architect for Commercial, Corporate and Investment Banking, and Jason Christensen, CIO for Payments and Treasury Management at Wells Fargo. I would like to welcome the panelists and the audience for tuning in. As you know, we're in the midst of a historical transition period that can only be compared with the second industrial revolution in terms of potential economic and social impact. The second industrial revolution was fueled by invention of simultaneously in a period of time multiple disruptive technologies: electricity, telecommunication, and the combustion engine, which also led to automotive, rail, and airline industries. Today, for the first time in almost a century, we are witnessing a very similar phenomenon as we are entering the hyper-connected world, with the following important maturing trends. One is the ubiquitous decentralized computing. Today, smartphones and Internet of Things devices, smart devices, have tens of thousands of times more computing power than mainframe computers just a few decades ago. Even a USB stick has more computing power than a mainframe computer in the 70s. And thanks to cloud computing, anyone can get access to almost unlimited amounts of computing and storage with unprecedented low cost per bits. The other phenomenon is a decentralized heterogeneous communication. So this was a movement that started with Wi-Fi and will hopefully be completed with WiGig and 5G. We'll soon be able to transmit gigabits per second of information at very low latencies. This will enable new disruptive use cases such as tactile control, communication enabled by latencies that are within the 10 millisecond range for tactile communications, and will allow, for instance, remote control of objects such as robots. Yet another disruptive trend is decentralized business processes with technologies such as distributed ledger and blockchain, where massive efficiencies can be brought into business processes by involving technology to replace middlemen, increasing settlement speeds with built-in auditability, also opening up the path for disruptive concepts such as digital and programmable currencies. Of course, then we have artificial intelligence, machine learning, data science, robotics, augmented and virtual reality, drones. All of these technologies promise to bring massive efficiencies and automation and personalization across multiple industry sectors. And just as natural energy resources like oil and coal were the fuel for the second industrial revolution, data is the fuel for this new era. And yet, we haven't been able to establish a proper framework for the economics of data. Tech giants have been making hundreds of billions of dollars from this data using primarily two mechanisms: the ad-driven revenue model and the two-sided business model. These models, despite bringing some conveniences to consumers and enterprises, have had serious socioeconomic impacts: ever-increasing wealth inequality, heightened sociopolitical polarization, and massive spread of misinformation and fraud. To create a sustainable global socioeconomic structure, we have an opportunity to address this, especially now that we are transitioning into the hyper-connected world. I'm personally convinced that these trends are not a threat, but an opportunity for financial institutions to expand our role to custodians of both financial and digital assets. This is why I joined Wells Fargo 7 months ago. That said, any opportunity can turn into a threat, and any threat to an opportunity depending on how you react to these trends. For financial institutions to have a major role to play in the hyper-connected world, we need to leverage the latest in cloud computing, distributed ledger technology, artificial intelligence, 5G, and any other relevant technologies to transform our businesses properly aligned with the disruption that is happening in all industry sectors, including ours. Today, our panelists are here to talk about how they see the future of technology and its impact on our business, and what they're doing today and planning to do in the future to adapt to these new trends. We're going to start with Tom Schack from Swift. Hi, Tom. Thanks again for joining our panel. Can you please tell us how you see the impact of these new trends on Swift and your role, Swift's organizational role in general, in the future of financial institutions?
Thank you. It's really a pleasure to be here. We just announced a new strategy, and in terms of the approach that we're taking, we're committed to several really important things. We believe that's going to be required to for Swift to take the digital transformation further and further. We think that we're really going to be in a position to rethink the art of the possible and what can be done. The economy is moving fast. Things are digitalizing very quickly, and we feel like we need to be in a position to really support our customers in that move. We're going to move from managing to enabling. We're going to look to harness the full power of technology, some of which you just mentioned in your opening remarks. And we really need to translate the purpose or our strategy into real actions. One of the key actions that I want to highlight in our new strategy is really for us to build out our new payments platform. It's an exciting adventure for Swift to kick off. And it really builds on top of the foundations, I think, that people know and have come to expect from Swift in terms of being an industry cooperative and prioritizing securities and standards and innovating at a pace that yields scale and factors in the proper amounts of risk and controls in the platforms. We're building next generation state-of-the-art digital platform that's going to really enable messaging and transaction services with effortless customer experience. This includes instant and frictionless transactions from account to account anywhere in the world. And with the reach that we have today, we think that's going to be substantial. We think it's a great opportunity to build on top of some of the existing services we have today, including GPI and our API services. At this time, our new platform is really going to be around end-to-end integrity and providing rich data services, based on ISO 2022 standards, which we've adopted, we've made available, and the industry is moving forward today. So lots of really good things to build on top of at Swift. And I'd highlight a couple of the benefits that come along with that. Our ability to compete in a more effective way with differentiated services, really based on low friction and efficiency, and again, the global reach and the trust that we have at Swift. I think the benefits will be obvious to everybody that participates with us. We also feel like we're going to be in a much better position to provide services to our end customers through transparency, through predictability, and maybe most importantly, through a rich data set, which again is enabled by the ISO 2022 standard. So this really gives us a chance to move into new products and services, new segments, new channels, and enable capabilities, not only for us and our network, but for our community and for the banks that we serve on. I'd like to drill down in one kind of focus key area for us in terms of artificial intelligence and machine learning. You mentioned in the opening the fact that we're in an era of hyper-connected world, and that data is the fuel for the new era. At Swift, we couldn't actually agree more. We think it's going to be the basis for tons of innovation and tons of improvements in just about every aspect of what we do. One really important one for us is to use predictive analytics and machine learning to combat financial crime. And I'd say that's a key priority for us and for our banks and for the community and for the world in general. We actually think that Swift's really in a unique position with our data assets, but the data assets that are actually controlled through privacy and controls and legal frameworks to protect the data of our customers and the community. We also think that that we're going to benefit from the network effect. The fact that we have thousands of financial institutions, the largest corporates in the world, the global reach, and the scale that we run at really puts us in a position where we can add context and a network effect that nobody else can actually offer at this point. It's interesting to note that Swift doesn't actually own, the majority of the data assets that we have. We're the trusted stewards of that data for our banks and for our community. But even that being the case, and even with the protections that we have in place, we think there's really creative things that we can do, again, to bring kind of context and to leverage a network effect. We have some really, really interesting ideas that we'd like to work with Wells and others on in terms of crowdsourcing knowledge and be able to collect insights from the community to improve our models and to be much more kind of precise and granular in the insights that we're actually able to extract from the data. So again, we think we're in a great position to leverage a new platform, the enriched data that we have, and to mutualize services, not only for the benefit and of the community and to build the network, but for individual customers as well. And with that, I'll actually hand it back to you.
Great, Tom. We're happy to see that Swift is making a fundamental shift from sequential messaging into a platform for transaction services. And you guys are really boldly embracing the move into digital payments. Let me put you on the spot a bit and ask you, what are Swift's plans to help us, Wells Fargo, in our transformation? How do you see you helping us?
Well, that's a great question. I would point to three things, as we kind of shape the new reality. One is just a relentless focus on outcomes that matter. There's lots of things that we can do. There's lots of priorities. You deal with that in your day, we deal with that in our day, but to focus on things that really matter is going to be a key priority for us. We also need to look for new ways of working. I think the expectations have really changed. That's kind of starting with the consumers, and that moves into cross-border payments and wholesale payments and the service that we provide to you and to our customers. So that's going to be a focus area for us. And then third, and probably my personal favorite, is really just being savvy and clever in terms of how we use the emerging technologies to bring the transformation forward.
Great, Tom. Thank you. And we wish you the best to execute on your visions. And now we'll go to Anne-Marie Facciolini, Chief Architect for Commercial, Corporate, and Investment Banking at Wells Fargo. Anne-Marie, welcome. Can you please give us a high-level update on your efforts at Wells Fargo on digital transformation and what you're doing to prepare the bank for the new era?
Yes, hi, good day. Thank you for having me. Sivash, as you said in your opening, I agree as well that financial institutions have a really important role to play today in this hyper-connected world. A lot of the technologies that you mentioned needing to be embraced are things that we have underway at Wells Fargo today. I would describe our digital transformation as not just being about technology, though. Instead, I would say it's about people, process, and technology. From a people perspective, we are adopting Agile so that we can deliver increments of value in smaller chunks to our customers. We're also starting to adopt products, customer value streams, and customer journeys instead of the old project mentality. This will allow us to put the customer first in everything that we do. On the technology side, I'd like to talk about a couple of things. I'll start with the application development side. So like many large enterprises, we have several, or I should say many, large monolithic systems. And we recognize that in order to remain competitive, we need to be more nimble and faster in our ability to meet customer needs. And so a part of our strategy is taking these large monolithic applications and breaking them down into small microservices and APIs that can not only be used internally, but externally as well to create some interesting partnerships. Microservices, by their very nature, do one thing and do one thing very well. And for that reason, they're perfect for making rapid changes quickly. Now, our strategy not only involves changing the way we build systems, but also where we operate. So from an infrastructure side, despite our plans to utilize the cloud more and more in the future, we currently are utilizing a private cloud on site. We're using the private cloud primarily for our internal applications, although I expect we will be able to not only continue to utilize the private cloud, but the public cloud, and also a few physical data centers across the US, making use of what's called now a hybrid cloud model. And the reason why we chose the private cloud was because it really allowed us to focus on building great code and building cloud native applications to prepare us for that next step in our journey. And by using a cloud platform, you really get the benefit of spending time reworking your code and making it the most efficient as possible because somebody else is responsible for the system's resources and where it's going to run. At Wells Fargo, all of our new application development is being built with the cloud in mind. And we're hopeful to start leveraging the public cloud sometime next year. To prepare for this, we've actually started doing proof of concepts with containers. As you know, containers are intended to allow for greater portability across multiple cloud providers. But what attracts us to the public cloud in particular is not just the ability to potentially use multiple providers, but also the unlimited capacity, the opportunity for innovation through, again, creative and innovative partnerships, and the ability to experiment quickly without these large capital expenditures that we used to have to make. The managed service options are also really attractive because they allow us to focus on getting our code right and building functionality for our customers and leave the underlying system management and database management to somebody else. Probably one of the biggest enablers I would say right now for our transformation is in AI. It is really permeating every aspect of what we do at the bank. It's not only being used anymore to gain insights about our customers for personalization reasons in our applications, but we're using it in the payment space for fraud identification by really interrogating the transaction data so that we can tell whether or not you've paid a person before, who that person is, where they are in the country. It's also being heavily used in document management around process automation. So processes that were previously entirely manual, so manual separation of sheets, manual classification of documents, manual extraction of data, is all being done through automation now. Those processes are being replaced with machine learning that does that separation, that classification, and that data extraction all systematically. And once you enable automated continuous learning into that process, the system starts to learn the changes that are being made and can adapt easily to any document changes. So it learns over time to stop failing certain changes. And so you don't need to continuously be making application changes. The system learns it itself. And finally, internally, one interesting application is around chatbots. So we're using AI in our chatbots specifically for our internal employees to help answer frequently asked questions and navigate to frequently used links. Now, with so much data in use, the demand for real-time information is forcing us to also experiment with edge computing. And this is a really interesting case study because in the capital markets area in particular, real-time data and instant calculations are so critical. So we do have a couple of pilots running in that area where we're using the edge computing to allow for better real-time responses, especially in the systems like trading applications. That's it.
Great, thanks. Thanks, Anne-Marie. These are the exciting initiatives, but how long do you think it will take before these efforts make a difference? And where do you even begin?
Yeah, that's a great question, right? Because there's a lot of work to be done. We've been undergoing this digital transformation for some time, and I can honestly say that we are really reaping the benefits of a lot of what we've done right now, of course, during the pandemic. So a lot of that automation that I mentioned has enabled us to move from needing physical people in the office to automating processes entirely, on the back end. So that's been a real benefit and something that we've been able to acknowledge and benefit from right now. As far as where you get started, on the process side, you look for those opportunities to automate as much as you can. The advantages of automation improve quality in the process, which reduces cost overall for the organization. And then we're also looking across all the major lines of businesses to understand where are their big transformational efforts. Those are the areas that we want to focus in on, recognizing that they are laying the foundation for the future.
Wonderful. Thank you so much, Anne-Marie. Great talk, and we look forward to seeing some of these changes and the transformation in the next year. And finally, we have Jason Christensen, CIO for Payments and Treasury Management at Wells Fargo. Jason, welcome. And can you please let us know how you see the landscape of payments shaping in the new era, and how you're leveraging technology in the business today, and perhaps a bit on your roadmap for the future?
Sure. Thanks for having me today. And some of what you're going to hear, I think, will line up nicely with what Tom and Anne-Marie talked about, because this is where the rubber hits the road. This is where we're talking about the live platforms and the live transactions that Wells Fargo processes. So I want to kind of go over three main areas today: what our current state is, where we are doing some innovation, and what some of our thoughts on the future are. So first off, like many large financial institutions, we're working in an ecosystem that has been put together and expanded and grown over many years and many organizational mergers. That makes a very complex environment. These platforms were also built many years ago and are highly optimized and highly customized. They process a massive amount of transactions on a daily basis, Many of our systems do over hundreds of billions of dollars on a day-to-day basis. That makes them very difficult to change, and our appetite to make massive changes is very small on these platforms. Thirdly, the environment is highly regulated and monitored for all types of access, changes, incidences, and if you put all of those things together, it makes us live in an environment that's very complex and very slow to change. And we need to change that. Ultimately, there are some fintechs in the environment that are much more nimble. They're looking at a very micro-centered piece of a payment flow where they're trying to kind of optimize for one aspect. So we need to kind of incorporate a lot of the things that Anne-Marie talked about in our environment so that we can be more efficient and deliver our functionality much more quickly. So for me specifically in our space, we are going to have to adopt Agile as our delivery model. We're far down that path, but there's always work to go. There's always ways we can be more agile and more nimble in our delivery. We need to reduce and consolidate the number of platforms that we have internally. Anne-Marie talked about, large monolithic apps, and while that's true, we also have many, many apps that transactions flow through in our ecosystem. So we need to reduce them, and we need to get to more modern technology standards in our architecture, such as event-based messaging and service-based calls that we're making. We need to start leveraging things like distributed ledger and AI/ML across the payment flow. And finally, we have to be able to deploy in a more modern fashion. Today, we're sometimes mainframe-based, sometimes on legacy hardware, but we need to get to the cloud, we need to get to services, and we need to get to containers in order to kind of facilitate all of this stuff that we're trying to change. Even with these challenges, we still are innovating. We still are making changes that will help our clients and help us process transactions more effectively. With partners like Swift, we continue to excel at certain transaction capabilities, and we're finding ways where we can optimize that flow for clients. I'm going to go through a couple examples. One is distributed ledger technology. We haven't talked about that much today, but that technology opens up a whole new set of capabilities that we can offer. One of the ways we're taking advantage of that internally is how we as Wells Fargo can balance our accounts across our international branches. Today, that process for us as well as our clients is somewhat complex, can lead to difficult reconciliations, and because the nature of how we process those, sometimes it can only occur in shortened windows of the day. Our thought is when we implement distributed ledger and can handle all of that reconciliation internally, we can move those to a much more real-time and rapid reconciliation for not only us, but for our clients, and we can hopefully extend the windows of processing throughout the day. Also, one area that we're focused on is data. What can we do? Shivas mentioned early on, data is one of the new parts of the changing economy, and we, as a major payment processor, have massive amounts of transaction data. How can we use that, and how can we make that be an advantage to us and to our clients? We typically, today, are using that in a fairly straightforward model to help reduce fraud that happens in our payment applications. Clearly, with the payment volume, we can do anomaly detection and quickly identify transactions that we don't think look accurate and help reduce fraud for us and our clients. But that's not where we want to stop. We have the potential to get much more proactive with our data, and ideally we can get to predictive models where we can actually help our clients in advance of payments that we expect them to make. We can give them better views on their liquidity, and we can help further identify fraudulent activities as they occur. So where does all this lead us in the future? We want to make payments ubiquitous and merge the lines between the various rails that exist today. From an origination standpoint, our clients want to move money securely and from a variety of funding methods, whether that's their balances, a line of credit, a corporate card. They want to ensure their payments arrive at the desired time, real time, next day, or even future dated. So by providing connectivity across all of our payment flows, whether it's ACH or wires with partners like Swift, a credit card, Zelle, real-time payments, we can ensure that those payments get to the beneficiary in the right time with full transparency in a way the client wishes to fund the payment, all in an efficient and seamless manner from the originator. So Shivas, I hope this gives you a sense of our journey, some work along the way, and where we are in our vision.
Thanks, Jason. That sounds really exciting. It's obviously you have a lot of work to do. Now, are there any other areas where this vision of payments from anywhere could be even more simplified for our clients? It seems like things are getting more and more complex every day.
Right, and that's a great question. One of the areas that we're really putting a lot of energy into as well is how can our clients either originate those payments or settle those payments directly in their ERP platforms? You know, we again are following some of the work that Anne-Marie talked about in how can we expand and publish a robust set of APIs that will not only make that integration possible, but also put that capability into the hands of the smallest clients if they desire. So I think we have a lot of transformation that we can still do.
Fantastic. Thank you, Jason. Thanks, Jason, Anne-Marie, and Tom. This concludes our panel discussion. And now we will go to the audience for question and answers.
Thank you to Siavash and the panel. Let us now take a short break before we open for Q&A and our open dialogue. We welcome your questions and please direct them by email to globalpaymentsadvisorygroup@wellsfargo.com.
Thanks, Ashish, and good morning to everybody in the Asia Pacific region. Thanks so much for joining us. I thought those panels that we just watched were really interesting and a great reflection of how significant the change is, both in technology and the digitization of the financial services product set and experience for customers. So I have a couple of questions to get us started here with the panelists who've joined us for this Q&A. And if you have questions, please feel free to submit them to the email inbox. And we'll try and get to those as we go through the session. But Jeff, I'd like to start with you. And we heard a phrase from Kausik, your colleague, about time to decisioning, right? And I think that's sort of an interesting term. It's sort of a rubric for the transformation that banks are trying to take. And I also perceive that time to decisioning historically maybe was a little bit of a risk control, right? So was hoping you could share your perspective on how banks can think about the path to transitioning from a batch cycle and working with risk and ops partners to a real-time experience for customers.
Sure, and I didn't have the benefit of hearing Kausik's answer, so you can compare what we say, but we do work with a lot of banks and other players, looking at this issue. And clearly one general approach, everybody is trying to find ways to ingest more first and third party data, stored in a data lake or other single source of truth, increase analytical power and try to improve, just the technical ability to make a decision quickly. The interesting thing that I've seen a lot of players doing, particularly, frankly, fintechs, is also looking about how can you simplify the product or how can you change the business model such that you just structurally reduce the risk that you face. So, for example, if you look at like a lot of the Chinese players we've worked with in Asia, if you look at just WeBank as an example, a lot of players are looking at the ones who offer basically instant decisioning, whether it's to consumers or to businesses or other parties. They've changed the model to where they're largely an originations platform, and they've frankly offloaded the risk for the most part to various banks. Likewise, you see the Square Capitals or Stripe Capitals of the world in the SME space. They have an advantage in that they actually see the payment flows, they see the receivables, and often they can lend against what money is coming to the SME. Same in the businesses trying to effectively replace payday lending, clearly a high-risk area traditionally. The companies like WageStream and PayActive have tried to work with big employers such that the employer agrees, oh, we know we're going to pay them, you can see what they're owed, therefore you can lend them money that they're going to receive soon. And so, not to dodge the question about the technical ways of offering instant credit while minimizing your risk, but I see a lot of fintechs in particular looking at how can you change the business model such that you structurally face less risk than you may have originally. I guess that's kind of the first way I would think about it.
Yeah, that's really helpful. You're right. There is an opportunity to kind of pivot a bit the model and what you're providing as an offering. Tom, I wanted to bring you in on this and ask, as you've been working or looking at innovation from Swift's perspective, but obviously working with a lot of banks and STP is clearly an important part of the future of payments. What are your thoughts on what will be the implications for banks in time to decisioning or operational velocity in the future?
Yeah, just following on the comments that Jeff just made in terms of trying to simplify the flows and the business model. This is a great time to do that. And Swift's strategy that we just recently announced is really anchored on enabling instant and frictionless payments and to move beyond messaging into full account-to-account settlement. So this, as everybody knows, is a very significant change. We've been thinking a lot about this year. The work's actually started. We've set up our advisory committees to work with our customers to really verify and validate what it is that we're building. I would highlight a couple of kind of key considerations for this. The first one is really interoperability and with existing payment system rails, processes, things that are in place today. There's not going to be a magic moment where somebody kind of flips the switch and we all move to the new platform. We are building a new platform, but interoperability and backwards compatibility is obviously very important for us and has to be designed very, very well, so there's no kind of break in the action or disruption of services. The second consideration, I think, to try to minimize that risk is really kind of the timeliness of the payment flows and the settlement of the transactions. And so I think we're in a situation where we need to enable services like pre-validation, to avoid friction in the payments and fraud, both prevention and detection. That has to be done upfront and quickly. And as you know, if you're doing a real-time payment or instant payment, you have no opportunity to kind of stop or reverse it. So this becomes very, very important for the overall credibility and the confidence in the platform. So I think the way that you have to do this from a technical point of view is obviously we're going to be focusing a lot more on analytics that are powered by events, not just training models on historical data. We're going to assume there's going to be a massive amount of data, just in Swift alone, with the thousands of institutions that we deal with and the billions of accounts that we deal with. It's a massive amount of information. And I think we also have to be really clever in terms of, the feedback loop and what do you do with the workflow when you detect things. So the ability to have immediate feedback, efficient workflow, and to be able to respond to, potential problems, including fraud, is something that needs to be worked into the process. And there'll be really kind of innovative technology solutions for all of those things.
Yeah, thank you. Yeah, I think both you and Jeff really touched on something important there, which is, this really does call for rethinking processes that are supporting the product offering. You mentioned a massive amount of data, and I want to pick up on that. There is a massive amount of data in our businesses, and ask Jason to talk a little bit about how should banks think about scaling both the utility of that and maintaining the integrity of data, right? I think about how many different systems we have that produce data just in the payment space alone, and getting it all into a structure that is usable but maintains integrity seems like a tall order. So I'd love to hear your thoughts on that.
And I think, data is the fuel. Chivas, I think, said it great. It's the fuel of the new economy. And so, the aspect about data is we produce more and more every day. It doesn't go away. And in reality, it gets more and more useful and more valuable the more we play with it and the more that we do with it, which is a very unique situation for us to be in. We as banks do have a fortunate where we can produce data that, can provide all kinds of insights for our own use, for our customers' use. And so it's really important to get that set up in a right way. I think some of the things that we're doing internally is, you have to spend the right energy up front to really tag that data along the way and understand how that data changes as it moves through your systems. I think it's easy to think we just grab data a certain way and we can manipulate it and play with it. But if you really don't understand data across your landscape and how it changes as it moves through, I think you'll miss out on some opportunities to really standardize it. And once you have that data standardized, Jeff mentioned data lakes. I think everybody's doing a data lake and trying to get that data in a central place. Being able to bring that standard set of data to your consumers that is consistent and reliable and tagged correctly, so how it's used and how it was created, becomes invaluable. We can use that for increasing our fraud engines and for gaining insight to grow our businesses and for providing transparency about our work to our clients. So there's all different ways that we can use that effectively, but I think it starts with treating data with the criticality that it deserves. And I think we haven't done that in the past. But with the tools and the technologies and the way that we can use it, people need to start doing that going forward. And we at Wells Fargo are certainly doing that, and we're going to be at a position where we can take advantage of that going forward.
Great. And thanks for sharing those thoughts. Siavash, I wanted to get your thoughts on this as well, and maybe you can talk a little bit about what some of the building blocks might be for a robust, technology or architecture approach to managing data, as well as maybe you can touch on the role banks need to play with regard to data privacy.
So kind of I alluded in my talk that a lot of the transformational technologies that we see is around decentralization. So decentralization of computing, decentralization of business logic, the distributed ledger, decentralization of cloud with edge cloud. We need to really move beyond data lakes to distributed databases and creating insights closer to where the source of the data is. Because if we want to do real-time personalization and speed up transactions, we don't have time to deal with things such as network latencies and all of that, especially now that 5G is also arriving. So we need to really start moving to edge cloud, hybrid edge cloud, and those kinds of mechanisms, and start planning towards that. And also, we need to keep in mind that when we talk about data privacy, we need to go beyond thinking that we're going to use our customers' data in order, for instance, to sell them better services or service them better. But we need to also think about custodianship of data on their behalf. You know, right now, there's a massive data robbery happening because of lack of regulations, right? Our customers have lost the control of their data. I really encourage everyone to look at this the documentary called Social Dilemma, that very well describes what's happening. And we have a major role to play as financial institutions to address that and protect our customers' data and mine the data on their behalf, right? So mechanisms to do that, it should be also on our roadmap and going beyond just managing financial assets and managing digital assets and data on their behalf, but managing, meaning mining value out of that data on behalf of our customers.
Thanks for those thoughts. Yeah, I agree. There is potentially a real opportunity here for banks to reinforce their role as trusted broker, that historical role. Let me go to Ashish and see if we have any questions that have come in.
Yeah, Craig, this question, it's about will digital enablement cause payments to disappear for the user?
Okay. Yeah, that's a great question. Clearly, we're seeing more and more that payments are being pushed into the background. So Ryan, maybe I'll get your thoughts, and then Jason, go back to you. And if you can, share some perspective on how quickly and how completely is that happening?
Yeah, thanks for the question, and thanks, Craig. I mean, I do think that it is happening, right? And this is really part of the open banking philosophy and really this Uber effect, right, that we've all come to live and enjoy and appreciate, right? If we think about it, payments are just a byproduct of another upstream event that is taking place. And certainly from a consumerist perspective, that is not really something that is forefront and of interest to them, right? Obviously clearing and settlement is still going to very much be something that's going to take place. But I do believe that more and more over time, we will see the start of the payment for the consumer fade into the background.
Yeah, clearly it's going that way. Jason, I mean, you're aware of this as well. What are some of the things that you're thinking about in the technology space to facilitate that? What are the things that we still need to look out for when we build our applications for that to work?
So I think as Ryan mentioned, the concept of a payment is not going to go away. The exchange of a payment for a service rendered or a good rendered is still going to happen. The question is how visible and how much action does a user have to put in to make that happen? Right. And that's where we're going to see it kind of slowly disappear. With the rise of like APIs, open banking, that makes the capability for us to integrate with our clients deeper and easier and kind of more quickly over time. We're spending a lot of time and energy trying to figure out how to get deeper into the client's ERP so we can actually integrate deeper and kind of have that seamless integration from the client into us as a financial firm and have them not have to go online and actually do a payment or kind of initiate themselves. We can just handle this all under the covers behind the scenes. I think technology has driven a lot of that, just the capability that we have, the ability to produce APIs, the interactiveness that our systems have today, the STP rates that our systems get to. We've talked about data, but having that data and being able to, make sure that we have models in place to ensure STP to kind of eliminate fraud and making sure that we can process that payment as effectively and quickly as possible is another reason that those payments will kind of disappear and dissipate over time. So I think it's going that way, Craig, and I think we're going to hope to lead the way on some of that.
Absolutely. Hey, I wonder, Jeff, just sorry to put you on the spot, but if I can pull you in on one additional aspect of this, right? One aspect of payments getting pushed to the background or becoming more invisible is it raises the potential for disintermediation of banks, right? And we see that open banking, right, either from a regulatory perspective or what's happening naturally in a market like the US is sort of on our doorstep. So strategically, how should banks think about, maintaining their value proposition in the value chain as this happens to payments?
Well, I certainly agree that payments increasingly just becomes part of the longer, the overall customer journey, the overall experience, whether it's consumer payments or it's SME payments. I think the other thing that's going on, and that's clearly affecting banks, whoever can own the customer and manage that relationship will increasingly capture the value. The other thing we see is not just moving kind of left to right across the traditional payments value chain, but also with the creation of ecosystems. Again, once you own the customer relationship, new technologies, new ways of working, new ways of engaging with customers allow you to disintermediate traditional value chains really across traditional businesses. And so we're really seeing people not only break down the value chain in one direction, but create these ecosystems in the other direction. So you look at whether it's, obviously people talk about the Alibabas and Tencents of the world, but in the US and the Western world, you also see the Googles, the Apples, the Amazons just extending. Once you own the relationship, everything from payments to financial services to everything just becomes another service that you cross-sell or upsell, on. And so I do think banks are in a challenging position where they need to do more to own that relationship overall, not just in payments, but just to stay relevant across all sorts of ecosystems, as they say.
Right. Yeah, it's an interesting thought. Payment, cross-selling the payment as an add-on to another primary service. I want to pick up on the ecosystem comment a little bit, and Tom, get your thoughts. We heard about microservices a bit in the recorded panels. And certainly, API connectivity allows a lot of virtual composite, value chain stacks. What is Swift doing with emerging technologies to play a role in helping the Swift community around potential ecosystem or network value?
Yeah, it's a really exciting time to be at Swift, and what we find from our customers and including Wells, that people want to do more with us. So that we're in a really fortunate position where there's lots of opportunities to co-create and co-innovate on emerging technologies and other innovations. As I mentioned before, with our new strategy and an entirely new digital platform, almost everything is new. Obviously with backwards compatibility and interoperability, but APIs are a main part of the strategy and the implementation of the strategy. We've made really good progress on that and in offering every service that's available and every piece of data that's available from Swift via an API as well. We're moving into cloud technology. We've been using private cloud technology internally for some time. We are looking at and expanding into public cloud technology. And then probably the third major thing is really our work with data. And as the ISO 2022 standard is adopted and the data becomes much more rich, we see some great opportunities for us to use that data for artificial intelligence, for machine learning capabilities, and to produce predictive analytics that would help us in everything from removing the friction to payments to detecting fraud, and to actually make it easier to do business with Swift. So all kinds of really exciting things going on, and lots of demand to try to figure out how to best apply this new technology with our customers.
Right. Yeah, Swift definitely is in a key position, or continues to be for our industry. Siavash, I'd love to get your thoughts. You've talked a bit about ecosystems, and what do you feel are the key, enabling building blocks for banks to be successful building out an ecosystem capability?
Craig, as the world is evolving towards what we call the hyper-connected world. That means that systems need to communicate across different industry sectors. Banking needs to get embedded into enterprise solutions. And for this to happen, that means that applications need to talk to each other directly in real time, right? So that means that we need orchestration of these applications. Microservices are going to be coming to the edge of the network. And for that, we need something like Kubernetes. Google put Kubernetes seeded it into the Cloud Native Computing Foundation as part of Linux Foundation. We need to do a similar thing for banking protocols. And I'm not saying like reinventing things that we can reuse. For instance, we use Kubernetes, but for things that we need to do for transactional banking, we need similar kind of standards efforts. And I'm not talking about creating middlemen, but creating protocols and having an organization that is going to help banks to communicate better and have these systems, Internet of Systems, work effectively, right? Otherwise, will become, irrelevant, because the future is about real-time, personalized services, and these heterogeneous systems talking to each other. So I'm really hoping, and this is something that we've been talking to Tom, that we can move swift towards that direction to provide a platform for us to create something like the CNCF.
That's helpful perspective. Thanks, Siavash. Yeah, I think clearly standards play a key role, right? I mean, in many ways, that's the backbone of Swift's early success with MT. But you know, the space in which standards are needed keeps expanding, I think, in the digital world. Maybe we can talk a little bit about innovation from a different angle, and the angle of the incumbent. And Jeff, I'll ask you for some thoughts, and then go to Ryan. I'm curious what your thoughts are about the balance between, you know, straight ahead innovation, you know, working from the business model or technologies that we have, and balancing an innovation portfolio with more unconventional things, maybe very, you know, leading edge technologies. We had a question from the audience about DLT. This might be a chance to touch on that. And how should incumbents, who still have to run their existing, you know, business model and operating model, how should they balance the near term and the higher risk reward sort of unconventional innovation bets?
Yeah, I'll try to come at this a couple different ways. You know, I work a lot with venture capitalists, both corporate venture capitalists and purely financial ones. And it's interesting with the corporate venture capital firms, you always see this tension between, you know, a lot of people say we want to drive innovation or identify innovation that will benefit our business. Other ones say, you know, we want these long-term breakthroughs. It's interesting. I really do believe that when you're looking for, you know, true innovation, true breakthroughs, you have to a little bit ignore your current business. I say that because as soon as you involve, you know, the even very talented, very capable business leaders, almost by definition, they're not looking more than 2 or 3 years ahead because they're focused on driving their business. By definition, that isn't, you know, very strategic when it comes to like long-term breakthroughs. And I mention that as a preface because, you know, what I've seen some of the most successful, you know, in a world that is stochastic, in a world where it's unpredictable what is going to succeed and what's going to fail 10 years down the line, you can't make, I'll say, you can't make investments purely on an investment by investment or opportunity by opportunity basis, because a lot of the most exciting things, frankly, probably have less than a 50% likelihood of success individually. But if you invest in a portfolio of them, you are likely to do well. And so to get to your question, what I've seen most of the very successful corporate investors do is really making a portfolio investments. They say, you know what, we're not sure which of these is going to succeed, but we know some of them will. So I work, as one example, with Ping An a lot in Asia. You know, last I checked, they had something like 30 new business building efforts going on. They've also obviously successfully launched, you know, Lufax, OneConnect, Ping An Good Doctor. They have 4 or 5 big successes. Nobody talks about the 25 or 30 failures, right? And so I think that stochastic mindset, that idea of we're going to throw, you know, not recklessly, we're going to throw a bunch of darts at the board, though, in the areas we all agree are subject to, like, they're massive opportunities subject to technological innovation, where we potentially have some opportunity. I think if corporations start to be a little bit more ambitious, throw the darts at the board, see which ones are taking off, it's unpredictable, invest behind those and stop investing behind the ones that aren't working. Like, that's the mindset that I've seen successful players take.
Yeah, that's really helpful. That would, you know, that's little bit of an adjustment, I think, for traditional product development, but it's a great perspective. Ryan, you talked to a lot of different banks. What are your thoughts on how they balance the innovation opportunities in front of them?
Yeah, I mean, to complement that, I mean, it's interesting, right? I mean, we're obviously a cooperative with very lean resources, and we see the constraints placed on banks with regard to their legacy technology and being able to really, spread their bets, if you will, across a broad portfolio. That's not something that is always easy for them to do. I mean, the way that we think about it is that we really kind of, are taking a very targeted approach to innovation, right? And, you've heard the team speak about that, whether that's Steve or Tom, talk about the transaction management services, with various emerging technologies that overlay that. And then we're going to look to innovate around that, right? And expose some of those capabilities and bring those to the center. I mean, I think the other kind of angle that I would bring is that, innovation really needs to be purpose-led. And that's a great way to also manage expectations, right? So Horizon 1, 2, and 3, and doing that, also kind of enables the ability to secure some investments in the short term as well as the mid to long term, right? And if you do that, then you're over time with purpose-led innovation, you're able to demonstrate to leadership that innovation is not, not just the, as Tom always says, the fun hackathons and the science projects which happen in the corner, right? You actually are enabling the corporate level strategy for a particular business. So that's kind of, that's how we think about it.
Yeah, that's really helpful. I'm just gonna, I know we're at time, but I'm gonna end with one last quick question, and Tom, ask you this, and then Jason. This is a question I've been thinking about lately in my role, which is, there's so much change going on and there's so much transformation we're trying to achieve in financial services, and this is a question I like to ask of leaders who are also hiring managers. What skill sets are you looking for? What are you looking to add to the team, right? When you're hiring, what are you really trying as a capability or capacity to add to that team effort?
Yeah, I think I'd kind of break it into two different thoughts. One is specific skills, right? So if you need somebody who's a specialized data scientist or knows business process or how to build out a microservices architecture, I think there's very kind of specific technical skills with some of the more evolving and emerging technologies that are required, and you could obtain those in a number of different ways. But I think probably the more important one is what we always look for, in great people. It's the kind of person that you give a challenge to where they just don't know if it can be achieved. Is the kind of person who kind of obsesses on, providing a solution that the world hasn't seen before. It's kind of an ambition and a passion that people bring to work that's contagious, and the others around them, whether they're clients or people that work with them, gravitate to them. So, it's a lot of those kind of skills that I find add the most value to the team. And I think when you add that in a very kind of inclusive culture with different perspectives, different backgrounds, different experiences, I think you really set yourself up for success.
Thanks. Those are helpful thoughts. Jason, what do you think?
Yeah, and I would echo a lot of that. I think being inquisitive is important. Challenging kind of the status quo and making sure that you're staying current on current technologies and always kind of trying to figure out how you can advance your platform. I think the days of a developer being able to come in and write code are probably gone. We're going to expect our technology staff to be able to write code, understand how that code gets built and deployed, how is it integrated with our clients, and really understand the business better, right? It's you have to have the full package. I think that's a little bit what Tom was getting to, and we're going to certainly be raising the expectations across the board. And I think as a software engineer, going into the future, you're going to have to really have a broad set of skills, and you're going to have to, be ready to kind of work in a constantly changing, evolving environment that not only changes from a business perspective, but the technology is moving just as quickly. So, being ready for that change is important.
Those are great thoughts. Very helpful. Well, with that, I'm going to wrap this up. I want to thank all the panelists for their time and sharing their expertise, as well as all of you logged on for this virtual conversation. I think we're all fortunate to be part of a really fascinating period of change in our industry. So I'm going to turn it over to Ashish for any closing comments.
No, all I would say is I don't know if George has any comments, concluding comments, but I just want to again thank the panel and the participants for joining, and Craig for you moderating. And you did a great job in incorporating the questions that we got from our Asia team, who particularly Robert Lin and Jimmy Lee, who've been working with our clients, particularly in Greater China, to get those questions. So thank you for incorporating what their request was. George, any last words before we wrap up the evening?
Well, it leaves me thinking a lot about what we're doing and not doing. But from our perspective where we sit, it just makes me think, and many of our customers here and clients that might be watching, when we think about our world, 60% of the trillions of dollars we process every year stay on our own books. So we know where they start and we know where they end for customers in over 200 countries around the world. And these relationships consume other wealth products, investment banking, and loan services, and others. But the insights that we derive from that information, I think we barely really fathom. And the leverage, though, for the network is that we can improve processing for everyone, and everyone can improve processing for their own customers. So, when I sit back and listen to all of this, I keep thinking that the insights and the data, the discussion around data is really important in the space where banks are serving banks, because we're, on one hand, third parties, and at the same time, our regulators expect us to be primary partners. And so we have this unusual but fantastical opportunity to share this data around processing, service, product, and compliance, and hopefully able to deliver a global end-to-end solution that encompasses all of that. And frankly, I think when I sit back and think about the trillions that settle on our book every day, or billions every day, it's kind of an opportunity for us to share more broadly what we can learn from that and help our customers improve their customers' experience.
Well, thank you. With that, I think we're going to close our day 3 discussion, and we look forward, and again, thanks to the panel, and we look forward to the participants for joining us tomorrow. Have a good evening, everybody. Cheers.
Thank you.
Thanks, Ashish.
Thank you.